Greetings one and all, welcome to another episode on the Money Council with guest in the studio Abdul Davids from Camissa Asset Management. And what we've been experiencing from the outset or beginning of 2022 is the equity markets being under quite some pressure. And this is obviously at the back of macroeconomic changes and geopolitical tension and wars that's happening in Europe. And Abdul will be discussing this where we're looking at some of the economic indicators that have influenced the market and have created volatile markets right after this.
حي على الفلاح.
Welcome back to the Money Council. We are discussing volatile markets, that being the equity space in particular. And beginning of 2022, right through for the past 4 or 5 months, we've obviously experienced coming out of the COVID-19 lockdown pandemic, but then also with serious tensions and conflict happening in Europe. And when we look at some of the indicators and influences to the market, we obviously look at what's happening in the US as well. And with me is Abdul Davids from Camissa Asset Management to look at some of these aspects affecting the markets and why it has been so volatile over the past few months. Assalamu alaikum, Abdul, and welcome back.
Wa alaikum salam, and shukran for the opportunity, Adnan.
So, I mean, we've seen with the United States and their Reserve Bank, or equivalent Reserve Bank being the Federal Reserve.
Yes.
They've increased their federal rate, which is essentially their Reserve Bank interest rate, by 50 basis points.
Yeah.
And also at the back of inflation really ramping up within the US borders for the United States citizens. And this obviously influences the rest of the markets.
Yes. Yeah.
So perhaps just starting off at that point, what does this mean when we see the Federal Reserve increasing the federal rate? And then also with high inflation in the US, how does that impact the rest of the world?
Yes, a very good question. And I think our viewers might think that what has the US got to do with us here in South Africa? I think it's important to, first of all, talk about inflation. You talked about wars at your introduction. And unfortunately, the events in Europe and Ukraine in particular has pushed global inflation to multi-year high levels. So currently, if we look at the European situation, I mean, both Germany and the UK is running double-digit inflation already. The US is well on its way to double-digit inflation. They're sitting currently just under 9% in terms of the inflation rate, which is the highest in quite a few decades. Yeah. And, you know, in the 80s, they thought they slayed the inflation monster, you know, because globally in developed markets, inflation was hovering between 2 and 3%. And that allows central bankers the world over to reduce interest rates quite significantly, because the key thing is that people always talk about the real interest rates, which is effectively your normal rate less inflation.
Yes.
So when inflation is running at 2%, for example, you can have a 3% interest rate and still have a real rate of 1%.
Yes.
Because you take your 3% minus your 2%. The math is simple, but you know, it's quite important to understand that. So when inflation is ramping up quite significantly, it means that your real rate of interest rates are actually negative.
Yes.
Because to start off, I mean, the US is probably an extreme example. They started off at 0.25% interest rates, and inflation, as we just discussed, is say 9%.
Yes.
So it means that they've got a negative real rate of almost close
over
to
8%.
8.75% effectively. And that has meant that the Federal Reserve, as you've said, their version of the Reserve Bank, have been scrambling to raise rates. Initially, at the start of January, everybody was looking at 25 basis points increases, or 0.25%. So the 0.5% in some quarters has come as a surprise. We're obviously not surprised. We expect interest rates to continue to grind higher in the US. But effectively, that has set the cat amongst the proverbial pigeons, in the sense that inflation is high and rates are going up. That too is a dangerous cocktail, non-alcoholic, but effectively has meant that that has had significant negative impacts for equity markets as well.
So when we talk about inflation, this is the general price of goods and services, whether it's in a South African context or global context. Now, at the back of this European conflict between Russia and Ukraine, to my understanding, they are both grain producers and exporters.
Yes.
And because of the conflict regions, how has that impacted the rest of the world
Yes.
And has influenced this price increase?
Yes, very important discussion, because ultimately, if our viewers go back 2 years, we all know about the COVID impacts,
Yes.
the lockdowns, and the impact that had on logistics systems globally.
Yes.
And China being quite a stark example of that. And that already pushed inflation higher, because with logistic issues, supply becomes constrained, demand is still there, people want their goods and services, and that's pushed up prices. In this current environment, over the last 4 months, we've seen the additional layer of war is now impacting as well. And as you rightly said, Ukraine has been the breadbasket of North Africa, for example. I mean, Egypt gets, by my research, about 40% of their wheat from Ukraine. So clearly, this war has impacted that food chain as well. And then we've had commodities also going high as well. So that has exacerbated the inflation monster. And why is inflation such a big concern? The reality is that inflation, by its very nature, if inflation is high now, it will be lower in a year's time, because of the base effect. But the problem is inflation expectations.
Yes.
Because what then happens is that because my experience inflation is higher, I need a higher salary from my employer. And that has a virtuous sort of impact, in the sense that because you're raising the general price level of wages, next year we have to do the same, because the company now needs to raise their prices to compensate for the higher costs.
Of course.
So the problem with inflation is that the secondary impacts can last for a very long time. And you then effectively have this rising tide where the general price level goes up.
Yes.
And the biggest loser are the consumer, because we have to pay more for everything.
Certainly.
And the stock of money is the same, so the value of money then decreases in high inflationary periods. And that's why it's so important to get a handle on inflation quite early on. Unfortunately, for a lot of banks, and sorry, this sounds like an economics lesson, but the reality is that central bankers only have this one tool. They can only raise interest rates. And the idea there is to curb consumer spending, to try and force prices down. And it's a blunt instrument, and especially an ineffective one, when the very reason why prices are going up is not actually because of higher consumption, but because of supply.
Yes.
So, it's one of those big challenges that we have in this global economy.
Certainly.
But that, unfortunately, is where we are currently.
And I mean, this definitely has a major impact on your personal financial planning as well.
Yes.
Your budgeting. I mean, we see fuel is becoming more expensive, food is becoming more expensive, and so on and so on.
Yes.
If we're looking at it in a South African context, also interest rates have steadily gone up. From your point of view, do you think this will continue into the year 2022, 2023?
Yes. Yeah, unfortunately, our inflation is actually ironically below the US, but it's hovering above the band of the central bank. So I think, with that scenario being persistent, and the jury's out whether inflation will stay at these levels for the rest of the year. But if it does, I think our Reserve Bank has very little room other than to just raise interest rates. So we'll probably see another couple of rate hikes in South Africa, which is not great for people that have debt, that have either mortgage bonds or car loans, for example, because it means that your interest rate goes higher, the cost of money is higher, and which means that our viewers and consumers have less disposable money or income to spend on essential goods and services as well.
Abdul, now looking at our theme of this discussion is around volatile markets. If we just look at the chart that we'll be putting up, where we're looking at some of the Camissa funds, we're looking at the general American Dow Jones and the FTSE index, as well as Bitcoin, bringing in some of the cryptocurrencies and how that have compared to the equity markets, just to give some perspective around the volatility. Maybe just to talk through that.
Yeah. So I think, first of all, our funds are down year to date. We're down about 12 to 13%. And the reason for that is twofold. Firstly, we've seen general, what they call risk aversion into the market. When interest rates go higher, people tend to be risk averse, which means they tend to liquidate their investments. So that's a direct impact. The secondary impact is that with high inflation, as we just discussed, means that costs of companies go up. which impacts their earnings.
Yes.
And you should see lower earnings being reported by companies because of these cost pressures as well, which effectively means that the valuation of these companies come down as well.
Yes.
So that's the equity impact. What we've also seen in this current market is that the last couple of years have been good times for the US market. With the record low interest rates, we've seen a lot of money, and especially unfortunately from our millennials, from new investors coming into the market, anything from Bitcoin to what they call these meme stocks that have been flavor of the month, that have done exceptionally well.
Yeah.
But there's no what we call gravity to them, in the sense that Bitcoin doesn't produce earnings, it doesn't pay out cash. A lot of these meme stocks are loss-making in their very nature. So, when interest rates go up, suddenly millennials have less disposable income.
Yes.
And now they're trying to raise income, they're trying to raise cash flow.
Yes.
So they unfortunately sell everything that has done well for them. And that's why year to date, I think Bitcoin is still down almost 50%.
Yeah.
A lot of the meme stocks, and meme is really literally from the millennial sort of language, those flavor of the month type of stocks that have done exceptionally well over the last 2 to 3 years as well. So they've been disproportionately harder hit, and also the broader markets as well. So alhamdulillah, our funds have outperformed in a down market. And we certainly think that there's still a lot of risk attached to some of those more exotic type investments, the crypto investments, the meme stocks, for example. So whilst they've all fallen a lot, we don't still think that there's value in a lot of those stocks, unfortunately.
You're touching on the fact that there's no intrinsic value to some of these exotic assets versus the equity market. If we're now looking at the short-term underperformance, one, obviously, from an investment point of view, you should be having a long-term view.
Yes.
And maybe just talking to that.
Yeah, unfortunately, whenever markets are down, I get 10 to 15 phone calls a day. Rattled investors, unsettled investors that are worried about their savings. I think the key thing, as we saw in COVID in March 2020, for example, people should not panic. Especially for investors that have a 3 to 5 year minimum time horizon, even longer, hopefully. Markets tend to correct over long periods of time. We've had the global financial crisis, we've had the global COVID crisis in 2020, where markets fell 35% in a very short period of time. By the end of the year of 2020, we recovered all of those losses. So it's very important, and probably the most important message to our viewers today is that please do not panic. Markets will recover, and it's really when you sell your investments after you've made a loss or paper loss, you're actually crystallizing it, and you never have a chance to recover from that investment loss. So I think that is probably the most important message. Markets are actually normalizing.
Yes.
I always said, when the US was close to zero interest rates, it was a very Sharia compliant market, because zero interest rates is obviously Sharia compliant.
Yes.
But in conventional markets, actually we're in a normalization process.
Yes.
Because the normal rate for the US should be 2 to 3%, and not the almost 0.5% where we're sitting at currently. So that normalization process is painful, but it's necessary. And what will happen is that a lot of these excesses will be whittled out of the market, and capital will be allocated more rationally into this market as well.
Of course. Thank you for that, Abdul. I think the message is quite clear around this volatile market, is that you wouldn't want to be in a situation where you've bought at a high price and now you're selling at a low price because of this volatility coming through, particularly in the equity space. The conversation around exotic investments, it's another kettle of fish. But I hope you've drawn some benefit from this episode. Do subscribe to the channel, share and like this video, and do click on the bell if you want to catch up and have notifications to future episodes. Thank you for your time. Until next time, shukran, bye-bye.
حي على الفلاح.